Hello, everyone, and welcome to XRPL Insights on-chain finance. My name is Odelia Torteman, Head of Digital Assets for XRPL Commons. And in today's session, we're going to dive into DeFi 2.0, basically the second wave of decentralized finance, which is structured in a more compliance-grade enterprise framework, user-friendly manner. And in order to do so, to dive into this fascinating conversation, I have the pleasure to be joined by one of the industry key players and a great partners of ours, LEDGER. So please join me in welcoming Takatoshi Shibayama, Head of APAC and Global Head of Blockchain Services for LEDGER. Welcome, Taka.
Thank you very much for having me on your show.
Thank you for joining us. So Taka, you have quite a substantial background with many years working in the financial service industry. Why don't we start with a quick introduction from yourself about your journey and how you got into LEDGER?
So I've started my career in traditional finance with many people in finance. However, I started off in kind of the buy side of the business. So my main job was to invest money for the bank. So I started off looking at distressed corporate situations. It might sound esoteric, but basically we look at companies that are needing of restructuring. And we look at the capital structure of that company, whether it be debt or equity, and then we price them to the market level. And if we see that the prices are below, market prices are below of what we think the fair value should be, we bought them. And then we went to those companies to try to, fix the problems that they have. It could be managerial, operational, it could be financial. And then we try to kind of value up those businesses to where we think it should be. And I did that for about 20 years, both on the investment banking side and then after in the hedge fund side, and also had my own hedge fund doing kind of the same thing. And in 2016, I kind of stumbled across Bitcoin because I thought, I moved around different countries in my life, and I did invest in buying bullion gold, and then moving those things around was quite difficult. And I thought, isn't there a better way to move this thing rather than like physical gold, but like something else? And I thought, well, ETFs could be one thing, but it's not really the real thing. And then I kind of like I thought about, hey, I saw some Bitcoin ATMs in Hong Kong, and I thought, okay, maybe that's something interesting to kind of look into. And I did my own kind of research, and I kind of got into the whole thing myself. And then in 2018, I made my professional move into the space, and here I am, 8 years later.
Fascinating. Very valid experience, especially with the direction that this industry is going, and very relevant to some of the themes we will be speaking about today. So again, thank you for joining us. So I want to start a little bit with LEDGER, right? LEDGER started as a hardware wallet company and has grown to be probably amongst the most recognized digital asset security company in the world, with over 9 million devices sold. We have LEDGER Wallet, which is an active financial platform. And of course, LEDGER Enterprise, which is almost a full institutional custody infrastructure, which covers both DeFi, tokenization, trading, and others. I want to ask you a bit, what was the organizing thesis behind this evolution of LEDGER as a company and through the products that you now offer?
So LEDGER as a business started in 2014 when there was no particular crypto industry as we see it today. It was just a lot of enthusiasts who were looking into, Bitcoin and thinking, where can I hold my private keys? Back then, there weren't that many options, and I think Ledger really fit in well into that segment where it was a hardware device that people can touch, and it was easy to use, and you don't have to leave your Bitcoin on exchanges or any software, and you can have it in a hardware device kept safe in a safety deposit or somewhere else safe. But as you know, the crypto industry has evolved. There's been a lot of institutions that came in. And when I say institutions in this sense, it's not the traditional banks. I'm talking about just regular startup companies, people who started building businesses around digital assets. These companies also needed to hold treasury. Some companies did an ICO back then that needed to hold, their own tokens. A lot of the ICO companies converted their tokens into ETH and other types of crypto assets, and they needed to hold it. So Ledger Enterprise was built in 2018 during this at that time when companies were starting to hold digital assets, and that's how we started evolving. So initially, we just had cold storage solution that people can just store and save their digital assets, but over time, these companies wanted to have their capital to work. So just like you have fiat in a bank account, normally with crypto assets you don't have interest, but then with POS chains you can have staking where you can earn some yield on your assets. So that was the first feature that we provided, and as the story goes, we as the DeFi industry started to build up, we created things that people can access DeFi, and now with traditional banks and et cetera coming into this space, they want stablecoins, they want tokenized securities. These tokenization engines were necessary, so we built them for that as well. So that is the general evolution where Ledger started off with a retail device, and then it morphed more into a product provider that can service not just retail but institutions who are in this digital asset space.
Yeah. And I want to continue this thought because indeed what we're seeing in the last, I think, 18 months is a huge adoption surge from the institutional side of players to everything that has to do with digital assets, right? More and more experimenting. How can they start their digital assets journey? Which product should they launch to start with? How do they define their architecture, their model, and so on and so forth? I think this trend was very much led by the regulation, right, which standardized this. So from MiCA in Europe all the way to the Genius Act in the States, and now also hopefully with the Clarity Act, which will be able to give us further clarity to how we deal with these assets. But I want to ask you, beyond regulation, what are the other key elements you believe have been the key indicators and the key catalyst in the last 18 months for this adoption surge we're seeing?
Yes. So I believe that the institutions also started to understand the benefits of blockchain technology, and I think I would say they probably knew it before, not just like 2 years ago, but they knew it back in 2017 when they first heard about it in the news. Initially, it was just about Bitcoin and a few other crypto tokens, but they looked at the underlying technology that supports these tokens, and they thought, okay, this can be used for something. And they understood that the industry needs to develop a lot more. The infrastructure needs to be battle tested a lot more until they can actually use it. So during that time, they saw the proliferation of stablecoins as an example. They thought, okay, this is something that we can use because in the fiat world, we have SWIFT. There's settlement times take a lot longer than in the blockchain space. So they thought, okay, maybe we can speed up the settlement period from like T plus 2 or 3 to near zero. I think the other things that I still remember back in 2017, we called them security tokens back then, or we
Absolutely.
called them STOs, but
Exactly.
now they morphed into RWAs. But there was a lot of conversations around that. I do remember banks back in those times were also mentioning about this, and they were quite interested in the underlying technology and how settlements can be done much quicker. And I think that has now kind of taken a lot more shape, and we see a lot of companies issuing RWAs and experimenting of how they can distribute these or what are the use cases. Those are the kind of things that we have seen in the past several years. And then, and back to your question, in the last 2 years, definitely these traditional financial institutions have definitely kind of come into this space and said, okay, we've seen, this work. We see a usage or utility of these tokens and how we can interact with them, and then let's just start experimenting with it. And obviously they'll need some kind of infrastructure to hold those assets. So there's been a lot of, especially in Europe and now in the US, there's been a lot of banks kind of looking into this space and trying to find a wallet provider or infrastructure that they can service their own clients.
Absolutely. And you've also mentioned stablecoins, right? Which I think have been one of the backbones of this adoption momentum we're seeing. Stablecoin in the beginning, I think they were designed as a transit mechanism. You've mentioned in the early days, in the beginning, they were designed as a bridge, right? Mainly from the CeFi world to the DeFi world. And today we're seeing much more use cases that are moving away from that, right? From basically moving in and out of position to settle different types of FX corridors, to settle trades. And now they're really becoming, I think, a strategic asset on their own, serving as collateral, serving as liquidity, as a funding currency. We will touch it also later on. Now we have this huge trend around stablecoins vaults, right? If we're speaking about yields and the whole evolution of that. So I want to ask you, what do you see within your clients and partners? How do you see this shift in the way they look at stablecoins? What are some of the key use cases and products that they have in mind, which are putting at the center stablecoins?
Yeah. So I could explain it in a B2C and a B2B type of a way. So on the B2C side, I definitely started to see a lot more, especially in the crypto industry, trying to offer stablecoins for like cross-border remittances and payments, etc. I mean, this has been kind of a use case that was, the initial ethos of Bitcoin, right? So they wanted to be able to remove the middleman and move, assets in and out of borders without any interference. And that was kind of the point of Bitcoin to begin with. And I think, stablecoins have, in a way, achieved that. And I think a lot of payment companies in this space are looking at, okay, how can we have different types of underlying solutions? So obviously they'll keep their fiat infrastructure, but they also will experiment with blockchain technologies so that they'll also have stablecoin rails. So I think a lot of the fintech payment companies are starting to think, okay, for the retail user, in my view, and my personal view, is that they don't really need to know who actually what infrastructure they're using, right? So if I top up my fintech app with my own fiat, if it goes to a fiat banking rails or if it goes into stablecoin rails, it doesn't really matter because as long as it serves the purpose of why I'm using that fintech app. And I think a lot of the fintech companies are kind of experimenting with that, trying to basically, the word is embedded finance, to have kind of both rails accessible for them, and also as a hedge for them as well. So if one rail doesn't work, then they could always switch to another rail. On the B2B side, I think especially on the traditional banking side, they're looking at interbank settlements. I think this is one area that can serve extremely well for banks because they can use that capital immediately. So, obviously, people might know that banks actually borrow and lend to each other overnight, right? So these things, they'll have to settle in a different time, like tomorrow, basically. But if they can do it today or in a few seconds, then that'll be much better. So I think they're looking at these interbank settlements as a way to use stablecoin rails, and I think that will not be seen by any retail at all. It'll be something in the background that kind of runs the blood of finance, but it is a strong use case that we see today.
So from intrabank to interbank to settlement rails, right? Also looking at to stable from, what we say from storage to utility, right? I think one of the key use cases we've seen recently is from a treasury perspective. So for treasury teams that would like to work with stables today, what are the real opportunities? And we get this question a lot, right? Of course, treasury teams diverse, whether it's a global bank, whether it's an SME, or whether it's a fintech. From a ledger perspective, how do you see this, the usage of treasury teams in stablecoins?
So, nowadays, a lot of the companies that hold treasury wouldn't hold various crypto tokens at this point, right? I mean, obviously, it's a very volatile asset class, and then they need to constantly be hedging their positions. So, having their treasury in stablecoins is quite normal. And, I work for a different custodian before, and I work for Ledger today, but, there's an increasing number of clients that are using or holding stablecoins. Now, if they're just going to hold it in cold storage, then it's better to just have fiat in a bank account, right? Because at least that is earning interest. Stablecoins generally are not. So they need to make their assets work. So, for Ledger, what we're trying to do even with the retail side and the institutional side, is that we become their savings account. We need to provide them with the features that they can make their capital work while they sit idle in cold storage. So on the retail side, we have teamed up with a lot of DeFi and also earn products so that people can earn yield on their stablecoins, and on the institutional side as well. Obviously, for institutions, they're a lot more picky on where they can deploy their capital. But starting from just native staking to lower risk profiles, it was something that they started to look at. And then now with the growing RWA products that are out there, that's another way that they can convert their stables into an RWA product, which they already know, and it's easier for them to access those without going through a brokerage account.
Yeah. Right. So basically, you've mentioned the whole world of yield, which is of course one of the key elements that now we're seeing with regards to the ability of both retail users as well as institutional to be able to put their digital assets into work and to get more product and more offering around that. And I think this is one of the key exciting things that we have, which is a huge result of the recent protocol upgrades we've seen, both from an XRPL perspective, where we have recently introduced the new XRPL native lending protocol, which is currently in voting. It sits on the XLS 65, the single asset vault, and enable basically to aggregate liquidity in a single asset vault structure from different types of asset classes that lives on the XRP ledger, whether it's the XRP, the RLUSD, or as you mentioned earlier, basically RWA-based tokenized assets on the XRP ledger, and enables basically to generate exactly that, the on-chain credit and yield infrastructure directly, in our case with no smart contract, with no wrapped tokens, and with no bridges, which I think is a very interesting value proposition, because from our perspective, we see that the users have become a bit more sophisticated, right? It is no longer just a question of the mere APY, but rather where are the yields coming from? How is the risk mechanism being structured? What does the exposure look like? How does the capital behave? And I wanted to ask you again, given the fact that Ledger, you are such a pioneer when it comes to yield. I mean, you mentioned since 2017, the ICO, the merry days of the ICOs. What are the key considerations you're hearing from your clients now when it comes to yield?
Yeah, so I think in this crypto world, we kind of generally use very vague words to kind of express financial return. I think back in the other market cycle, we used staking for a lot of yield stuff, and then now in this market we talk about yield. But generally, when we talk about yield, there's native yields, right? So let's say if you're looking at a security product. So let's say I have government bonds or I have corporate bonds. They have native yield on it because that's how they're issued, right? So they might be 3%, or for a corporate bond it could be 5%, etc. That is a native yield, and that's the financial return you get on it. A lot of the yield products that we see today are not these type of native yield products. Right, a lot of them are generally trading strategies. So basically, you're giving assets to basically like an asset manager to trade the tokens that you have given them for a financial return. So a lot of our sophisticated clients are always kind of looking at what's underneath the hood. So what are the trading strategies? What are they deploying into? What is the kind of risk that they're taking? What kind of infrastructure are these people trading on? A lot of these things come into consideration, especially with sophisticated investors, because basically, you're relying on a third party to manage your assets. So, if it's not the native yield that we're generally kind of accustomed to, they do want to see disclosures on what they're actually, putting their assets into. And that's the key thing that I think, for this conversation about DeFi 2.0 is that if we're going to evolve to talk about more about yield products in vaults, we have to do a lot more. We have to give a lot more transparency on what exactly the users are deploying their capital into. I think some do a good job, but I would say majority of the cases is still in this industry is that the transparency is not really there yet for sophisticated investors to safely or comfortably put their assets to work.
Yeah. Fully agree. I think this is something we've always seen, in the evolution of market. First, you have the more experimentational, the DeFi native individuals. And now as we move towards a more institutional side, of course, transparency becomes an issue, much more compliance grade, having proper, we haven't mentioned corporate governance or governance in general, risk framework, things that comes a bit more from the traditional financial market, but are extremely essential. I want to touch on something you've mentioned, right? You spoke about native yields. So specifically for XRP, which is historically a non-yield asset given the structure of the XRP Ledger protocol, what does it actually mean now that we are closing this gap natively and enabling to generate yields on XRP?
So that's a very good question. And if we take a look at, let's say, Bitcoin world, right? So obviously Bitcoin doesn't have native yield either. And there were many protocols being built out to offer yield to Bitcoin holders. And I think it'll be the same with XRP as well. I think the main thing that, it would be interesting to explore is the types of risks that people would take in order to get this financial return or get the yield. I think the low risk or lowest risk that I can think of in terms of how people can generate yield on XRP might be through this lending protocol that you mentioned, because there might be, well, generally in decentralized finance, over collateralization is normal, so it's much safer because it's not unsecured loans. So I would say that the risk that people are going to be taking on these lending protocols will be much lower compared to, let's say, trading strategies that are being explored with these DeFi vaults. So I think that's, we can kind of explore various risk profiles to different types of yield or earn type of products, and then see what the community would prefer.
Yeah. Absolutely. And to add to that, I mean, the structure, the architecture of the XRP ledger is designed in a Lego block modular structure, whereby we designed these primitives. Now, for example, the lending native protocol, which enables users, whether it's an enterprise, whether it's a startup, or whether it's a bank, to use them in order to design these new yield/lending/credit vehicles in different ways. So from one side, it enables to do it natively without third party, without mediators. From the other side, it enables you to design it in a way which is relevant for you. And with the XRP Ledger, also the credit engine intentionally remains off-chain, exactly to mimic many of the design choices that the traditional financial service is adopting. And I think, in general, also asking you, since Ledger, of course, you are a blockchain agnostic that works with the different protocols. The XRPL, as we know, is deterministic by design from inception to support financial services with very unique features, right? Like the pre-built DEX, the AMM, a lot of compliance, freeze, and different types of aspect. If you, as a company like Ledger, looks at the XRP Ledger product roadmap and see what could the future bring, what are some of the features that you see as more exciting, and what do you see installed that we can work on together?
Yeah. So I think Ripple or XRP in general has always been focused on traditional finance or financial industries, or becoming a financial institution itself, right? And I think that really kind of works how Ledger Enterprise is looking at this market as well. If we look at traditional asset managers or even people who deploy capital in general, people want something that's similar to what they're accustomed to. So, being able to use an infrastructure that would reflect how they would usually, work in traditional finance is something that they would be most likely be able to accept and use. And I think that the way that XRPL has been building their token standards for this new, kind of world of blockchain usage fits perfectly with the traditional finance industry. So I think, especially around the, as I mentioned, the token standards, the clawbacks, etc., those things are something that they're definitely looking at, because they don't want, a transaction to happen permanently, and they need to, have those assets that went in the wrong place to be coming back. They want to be able to whitelist addresses. All these kind of features are super important for the traditional finance industry, and I think XRPL is building for that future.
Fantastic. And also adding on that, Ledger, you guys basically have amongst, I think, the highest concentration of XRP holders, right?
Yes, absolutely. So it's like the top three assets that are held on Ledger devices today.
Fantastic. So extremely exciting to see what we will be able to build together with those primitives from an infra perspective together with your user base. I want to touch base a bit more, on the credit aspect of things, right? So of course we have yields from one side, we have stables and other RWAs, which basically are the monetary base for many of these things. And the missing part, the missing layer, if you will, was always credit, right? How can we then put these assets into work to be able to again provide the different more complex, let's say, operational model, and to be able to define the borrowing against the assets, the using them as collateral across different types of product. With your background, again, working a lot in both in distressed asset, but also in the world of credit, how do you see basically credit investors looking into this type of on-chain credit? What needs to happen in order to enable this institution to really take this as the next evolution, not just as a nice to have, but as something that really defines the future of digital finance?
It's a very hard question to come up with to answer, because I could easily say that yes, regulations is super important, but I don't think they would fit this conversation at all. But that is one key element to it, right? But if I look at the infrastructure of how loans are created in the decentralized world and in the traditional world, is very different. And as I mentioned before, the closer you can get to traditional ways is the way that I think adoption would happen. So if I look at the primary mechanism of how traditional loans are being created versus a
How are they
decentralized
being
finance.
created, Taka? How are traditional loans being created?
Yes. So generally, if you think about, as a consumer, let's say I want to, get a personal loan or whatever it is, I have to go to a bank, right? Or a financial institution that gives me a bank. And in the decentralized world, the mechanism is that I go to a liquidity pool, right? And then there, how the interest rates are determined are very different. In the banking side, the central bank sets a benchmark rate, and then the bank adds on bank margins on top of it, and that's how you get a mortgage rate or a personal loan rate, etc. Where in decentralized finance, there's a dynamic algorithm that's creating a real-time pool utility rate. So basically, there's a hard jargon, but basically it's market determined. So to me, that's the most fair way that a loan should be, because it's pure supply and demand. And then in terms of the credit assessment, this is the part that's very different. In the credit assessment, basically, the bank looks at a company or a person and looks at their identity. What is their credit scores? What's their income? Can they pass through KYC, AML, right? Where in a decentralized finance world, it's purely over collateralization. So it's pure financial. So if you look at those kind of differences and then try to bridge it over, how can we get closer to what they're doing versus what the decentralized world actually works? I think the part that I think is probably easier to cross over is the credit assessment, because if it's over collateralized, there's no problem. And generally in the traditional world, it's usually under collateralized or sometimes uncollateralized. So I think over collateralization is a lot more secure, and then also kind of drives down the interest rates a little bit more. And in terms of the interest rates, that's the part that I think would be somewhat kind of more, I would say, difficult, because it's not very foreseeable, right? It's not predictable what the market rate would be in the future. Whereas if I'm borrowing from a bank, like say a mortgage rate, it's always going to be like a 3% plus or something like that. So that's another thing. And then lastly, I think what you mentioned, and in terms of like being composable, I think that part I didn't mention in the comparison, but I think the composability of what the decentralized finance brings to the table might be something that traditional finance finds very innovative, because for a bank they only offer very certain amount of types of loans, whereas in decentralized finance you could spring up a vault and then create a financial product very easily. So
Yeah.
yeah, so that's kind of what I think.
Yeah. I think one thought on what you said, with regards to under collateralized versus over collateralized, as you rightfully mentioned, the traditional financial industry does not over collateralize because we don't have a spare capital. And in order to bring this mechanism into the world of DeFi, you need to be able to accurately perform a risk analysis, right, and a credit scoring. So the way that the XRP lending protocol is designed is in an under-collateralized way, at least for the first version, to indeed be able to replicate this exact decision model and the framework of work. So again, different approaches. I think mostly for the DeFi 1.0 world, where everything was much more designed indeed for the more native crypto ICO world. The DeFi 2.0, which is again a bit more institutional, defines a different framework, which is again the direction, as we mentioned, that we decided to pursue, at least as a first stage. So this has really been phenomenal, I think, and very exciting also to see where this industry will go now with all these new, from one side regulation, from the other protocol upgrade, the interest that you've mentioned we're seeing for more and more players, the role that stablecoins are now taking. And I want to finish up by asking you the crystal ball question, which is, what excites you the most if you're looking ahead?
Right. So I think what be really exciting is to really see this blockchain technology actually really put to work rather than crypto speculation. And, I think, we spent the last, I would say, close to 10 years in this kind of world. Well, ever since inception till today, a lot of it was speculation. I think that era is ending. And I think that, the blockchain rails is something that institutions are going to pick up and then actually really maximize the use of it. And that's kind of what I am quite excited about, is to see how that's going to fit into our everyday lives without us even knowing about it. So that's one thing that I'm super excited about. The other thing that I also kind of, well, for my financial hat, that I've been in this space for a long time, is that the use of RWAs is something that I'm kind of quite interested in, because today we only see quite a handful of financial products being tokenized, and it's distributed to the Web3 crypto traders, right? I think that's kind of a simplified way to look at where it is today. It has not been distributed to the traditional world. It has not been, the financial products are less sophisticated. And then once these things start to become a lot more sophisticated, that's kind of when I start to see, okay, wow, this, blockchain has actually really been used. One of the things that I can mention as an example, which I'm quite interested in, is around these security products, securitization products in the financial world, right? So we have like CLOs, ABS, RMBS, those type of products that are basically a collection of various loans that are put together and then tranched into different risk profiles, and then sold to different investors with different risk tolerances. And this is, we a lot of times we talk about like fractionalization of RWAs and stuff. This is exactly what it is. The securitization products are like fractionalization of various risk profiles being distributed, and then with the use of blockchain and smart contracts and etc. These waterfall structures can actually work without actual humans being in the middle. And I'm actually quite excited to see this. It might be a little bit geeky, but I think this is quite
We're
exciting
all
to see.
geeks here, Taka. We embrace it.
Yeah, so that's something that I'm quite interested in seeing.
Fantastic. Amazing. And the last point you touch on, which is something I want to double click on, is of course the whole world of the agentic web, right? And the agentic finance, obviously huge. We've been extremely focusing on that. What happens when you put autonomous agents that are working across this ever increasing list of portfolio of assets that are now being tokenized, to your point now also, that can be put and defined per the risk scoring of each individual consumer / institutions, and then being built into different tranches, translated into investment strategy, everything being automated end to end, I think is absolutely fascinating. We've recently also launched the AI XRPL toolkit, which enables to automate a lot of these aspects. And just by the way, a week ago, we have reached 1 million transactions generated by agents on the XRP Ledger. So extremely excited about that as well. And on that note, I think we're very excited also to announce that we will be working together with Ledger as our partner to the upcoming XRPL Swell Hackathon that will take place in New York on the 24th, 25th of October, where we will be focusing very heavily on this intersection between the agentic web, right, and the new concept from Ledger, which focuses on agents on hardware. Do you want to touch on that a bit, maybe?
Yeah, sure, absolutely. So, we've always been trying to build our products, not just to hold crypto assets, but be used for other things. And we believe that humans should always be in the loop when it comes to, deciding on difficult things, right? So in this world now, we're very accustomed to automating everything, and then we want convenience, so we don't want to be in the loop, right? We want agents to do everything for us without us thinking about anything, and then we hope that they can do the right thing. But however, as you know, we live in a world where like AIs can hack AIs, right? I mean, I think in the first half of this year, we've seen tons of exploits in this space where I'm quite sure that a lot of the AIs were used to kind of find exploits in a lot of infrastructure in this space. And I think more and more we'll start seeing that AI agents will be attacking AI agents, etc. So how do you know the intent of your AI agent is always going to be true to what you actually want? Right? So we believe that ultimately humans should govern the rules of how AI should be. So they do the work, but we actually approve what they do. So obviously we can say agents can spend $0 to $100 without my approval, but anything over $100, we need humans to approve. Or within 1 hour, how many transactions can they do without me? And then over that they need my approval. So those things are things that we're looking to use ledger signers to hold the governance within our hardware, encrypted and also signed by humans.
Fascinating. Next generation of a hybrid sign-off model by Ledger signers. Really fascinating. So again, I'd like to take this opportunity to invite all of you to join us to New York, both for Ripple Swell and both for the XRPL Swell Hackathon, again with our great partners at Ledger to be designing the next generation of solutions and applications on the XRPL and on Ledger hardware and different types of applications. Taka, this has been a true pleasure, really welcoming you here. Any final remarks you want to give to the audience?
Well, hopefully we could do a lot more things with Ripple and XRPL. That's something that I've been top of mind for this year for me. So, I hope that we'll have something big that we can announce soon. And well, please stay tuned for that.
Absolutely, more to come. So thank you so much, Taka. Thank you all
Yeah.
for tuning in, and we'll see you on the next time.
Thank you
Thank
very
you.
much. Bye-bye.
Bye.